Good morning, traders and investors. Roger Scott here. Typically, I'm the senior strategist for the Trading Pub, but today I'm the senior risk manager for Lehman Brothers. Gotta have some fun in the morning, right? Anyways, welcome. Today is Tuesday, December 12th. It's a really big day. Today we have a CPI report, we have Fed announcement tomorrow, and we have a PPI. So the next 2 days are going to be very volatile. There's going to be a lot of directional bias, and the markets are setting themselves up for a move. Pre-open, we're up about 3 points on the S&P, we're up about 30 on the Nasdaq, and we're up about 60 on the Dow. None of these are really beyond random. These are random numbers, but it's good that we're starting the day positive versus negative, which means the report is at least expected to be somewhat bullish at this time. It's 7:36 in the morning. The report's going to come out in 54 minutes. It comes out at 8:30. And as I mentioned yesterday, here's what you need to be prepared for. Now, there's going to be two aspects of this report. There's going to be the year-over-year and year-over-year core and month-over-month. Nobody cares about month-over-month. Nobody looks month-over-month on CPI data. It's just not, it's too close. But in terms of annual data, you've got the regular CPI, and then you have the core CPI. Core takes away X food and energy, and that's what the Fed looks at because energy and food has been very much inflated lately. So they're looking at the core number. And what's interesting, they're not even looking for the number to be lower. They're looking at to match last number, which I think is very interesting. So the bar is not set very high to beat this number. Now, if this number happens to be 3.9 or 3.8 or 3.7, I'm completely making these numbers up to explain my theory. But if these numbers are lower than 4, it's really bullish for the market, and we can expect more bullishness from Powell when he speaks tomorrow. And it also means that the economy is getting tighter, which is really important. This number is really important too, but it's not as important as year over year. Sometimes you may see that this number's lagging, this number's higher, but the bottom line is we get a pretty good idea based on these numbers of which direction inflation is going into. So the good part is we'll get these numbers right after you get this video, or right at the time you get this video. I usually post it around 8:30. And then tomorrow you've got PPI and you have a major announcement from the Fed. So not only should we be looking at stocks, and this is the S&P 500, we broke above that resistance level that we had right here, and we're now moving higher. And the trajectory is definitely higher. This is a very major point. This is a very big major point of resistance for the year, and we're now above the year's high, which is a very bullish sign for the market. Now, looking at the bond market, and we have to look at the bond market, you could see that bonds actually jumped yesterday, all right? I was expecting bonds to go down, but they're jumped. This, again, increases the odds that the Fed is not going to take any action or in the near term and lower rates in March, which I think is completely asinine. But here we are, and that's what we're doing right now. So we got to pay attention to all of these things because we just don't know what will happen next. We simply don't know. But if this continues going higher, and if today's report makes this go up, that means that the Fed is more than likely, at least as priced into the bond market, going to start talking about lowering rates in March, which I think is a very distant fantasy. But pay attention to the bond market and see if it takes out this high. It'll be really important if it does, or if it breaks down and starts filling this gap, or keep your eye on the futures and notice if they start ticking higher or lower, and you'll get a really good idea of where the CPI is. You can also, it'll be all over the news, but the key numbers for the core is to be 4 or lower, and the regular number is for it to be 3.1 or lower. Anything lower than these numbers is very positive. And again, keep your eye on the bond market. That's going to give us the whole story and the stocks as well. Now, we don't have major earnings today, but we did have earnings from Oracle yesterday, and they were pretty nasty. I mean, look at this. The stock is down quite a bit. And this is one of the reasons why I tell folks, don't go making big decisions ahead of earnings. You simply don't know which way things are going to go. I mean, look at this. 115, 104, 10 points down, not good at all. Don't do earnings plays. It's not a good risk to reward. You can make a lot of money, but you can also lose a lot of money. So the only way you should do that is if you're speculating with very small size. But this is going to give network companies like Cisco And Pan W, some grounding today because they're in the same category. Matter of fact, let me take a look at Cisco real quick. See how it's reacting to this. Now, so far flat, but again, be really, really cautious today, especially on tech. Speaking of tech and speaking of sectors, I want to go over and see what's been going on, and then we'll get into the global economy. Let's see the last 5 days. Semiconductors, technology, they're starting to come back. Whenever you see semiconductors, technology, QQQ, tech stocks coming back, that means lower rates. These are very sensitive to interest rates. And for a while, they went down. For example, let's look at 6 weeks. I mean, we've been all over the place lately. But a few weeks ago, the Dow Jones was ahead, industrial were ahead, real estate, retail, and now semiconductors, home builders, interest rate sensitivity, technology, QQQ, consumer discretionary, communication. All the usual suspects are right here. So you could see that technology and financials and interest rate sensitive stocks are more than likely going to be looked at actively today if the number is positive. And tomorrow, oh boy, you've got Adobe earnings. Not only do you have FOMC, not only do you have PPI, but you also have Adobe. This could be good, though, because if the numbers are not solid, for example, the attention will be taken off of this and will be put on the Fed. Aside from the CPI and the PPI and the Fed, like that wasn't enough, you also have retail sales coming out and you have industrial production coming out on Friday. Now, let's talk a little bit about global economy and what we can expect. So market participants are refraining from big bets ahead of key U.S. consumer inflation reports later in the day and the Fed's last interest rate decision of the year. And that's why this is so important. This is going to set the tone for the next couple of weeks of the year and then some. And also the January effect. S&P 500 rising to a 20-month high. Blue chips and tech heavy, 1 3/4 high. You can clearly see that the market is very, very bullish. Not a time to short things. Federal Reserve kicks off its 2-day policy meeting in the day with market participants widely accepting the U.S. central bank to keep rates on hold Wednesday, but the market is still moving higher, so not all of the data is priced in. Core CPI, remember what I said? 4 over the year. That's the core CPI. That's the number you want to look at, and anything above, below 3.1 on the annual basis, or 3.1. The last number was 3.2. So you want anything below 3.2 on the regular and anything 4 or lower on the core. Europe is up a little bit. They're digesting softer than expecting U.S. wage growth. Household and personal care stocks gained ground on Tuesday. Telecom stocks underperformed. Doesn't look like we're going to get much of a tailwind today from Europe. Everybody's really focused. The whole world is focused on this report. It's the last big report of the year. China closed higher as investors anticipated outcome from a top economic meeting that could provide insight into the extent of stimulus measures expected in the coming year. Real estate and bank stocks underperformed on Tuesday. Japan closed higher today as speculative easing regarding the Bank of Japan's potential exit from its negative interest rate regime. Who told you about this 8 months ago? While investors also exercised caution in anticipation of a critical U.S. inflation data, gains in tech stocks led the overall market higher. And again, we're looking at tech stocks. We're looking at a pretty strong market. We're literally at 52-week highs, and I'm expecting some good movement today. Now, again, the market always pulls the rug underneath us, but we're looking for some solid numbers. Now, as far as sectors and what you should be focused on, look at semiconductors. Broke out right here. Look at home builders breaking out, technology. The only thing that's really lagging is communication. That's Google and Meta, by the way, folks. So just something to keep an eye on. And the other one is the energy sector. And energy is going lower. It doesn't look like the war is having any impact of it. I'm actually expecting a nice bounce because it's a commoditized market. And if we can go a little bit above, if there's a little more turmoil, we'll go a little higher. But remember, energy is very interest rate sensitive. And if interest rates are going down, that's a sign, or at least the sentiment of interest rates going lower, that's a sentiment for energy markets to cool off as well. Energy typically rises when stock markets are in a bad shape. Remember 2 years ago, a year and a half ago, when energy was rallying hard and everything was selling off? That's what we're talking about. So we got to be really, really mindful of that. Expect a lot of volatility. Let me give you some key levels on the QQQ. And you can see QQQ is already up a little bit above previous high. It'll be really interesting to see what happens on this report. The support level on the QQQ, just so you know, and this is really important, look at the gap here and look at how we broke the gap and then we went right back down. Very common. Very common. I call this the trapdoor method. But this is the support on the QQQ right now. It's at 382. So if we break down 382, I don't think it'll happen today. It took us 4 days to get to where we are now. But if we were to break down, we can start coming back down. Not anticipating anything like that to happen today. Again, big report, big report right before the market, about an hour before the market opens. Do not take any major action. The strength right now is in, as I mentioned here, it's in consumer discretionary, semiconductors, home builders. Weakness, communication services, be careful, Google and Meta, and energy stocks. Even the consumer staples and utilities are moving, which is kind of surprising, but they are. And what's really great is we're getting a little bit of love from smaller stocks. Now, I want to warn you about something here. Let me warn you here. Look at where we're at. We're still in this congestion, in this range. If you look at ARC, I showed you something 2 years ago, and we're still in this range. As long as we stay in this range, small caps or speculative stocks are not ready to break out. But once it does, watch out below. It's going to be a big move. Or watch out from above. It's going to be a big move, taking us all the way to the 50-day right here. Remember, this is monthly data. So again, be really cautious today. Don't use tight stops. Let stocks move. Give them some breathing room. Now, before I let you go, it's December 12th, and the Federal Open Market Committee is once again meeting to decide what to do with interest rates next. But that's not all the important about this specific date. There's more. According to a proprietary calendar by Graham Lindman, there's a stock that has risen every December 12th for the past decade. And it's not Lehman Brothers. Wondering what the on-the-clock stock is? Well, me too. They're tickers that have consistently risen on same dates for the past decade or more. These stocks move like clockwork, always trading on specific dates with a strong track record of a payout. And while we cannot promise future returns or prevent losses, the track record is undeniably. Graham and I will be live again today at 1 p.m. Eastern Time to tell everyone all about it. I'm very excited. I told Graham to do this 6 years ago, but nobody ever listens to me. Don't miss out. Click the link below, and I'll see you at 1 p.m. Eastern Time with Graham Lindman today. Don't miss out. It's going to be a lot of fun, and we'll talk about FOMC.